the Burn Ventures first Learning in Action learning series, or Entrepreneurship in Action learning series. So thank you for inviting me. This is great. I also work with Evelina and her team as a member of the Commercialization Advisory Board. So some of you may have, we may have met through that. But it's really exciting to share this information. As the founding executive director of the Charlottesville Angel Network, it's a passion of mine to help startup companies and founders of startup companies find the funding that they need and other resources. I am what's known as an entrepreneurship support engineer, and I help reduce the friction for founders to find their resources. I do operate out of Charlottesville, but you'll notice that I do a lot of things Commonwealth-wide. So let's dive in. Trying to change the screen and it's not letting me. I may need Ellie to come in here for a second and find out why it's not letting me. Hey, Al. One moment, please. Not using the buttons the way I usually do. I wanted to mention that a lot of the slides and information came from the SBDC in Virginia. I do a lot of work with specifically the Central Virginia Small Business Development Center. So. Can you hear me now? Today, our discussion objectives are to talk about early stage capital sources and what the differences are between angel capital and venture capital. What makes a fit for angel investing, and also what doesn't make a fit for angel investing, and then preparing you for an angel investment overview. So how does a business grow? Does it grow like this? Rarely. It really looks more like this, and it takes years versus months to find that curve. The typical growth of a company looks like this. And a lot of you are in pre-seed before you've even started a company and you have an invention that you're working on at university. But eventually you'll need to seed your innovation, and then you develop a startup. Then you move along the growth trajectory to an established company and expansion if you're successful. What sources of capital are available to early stage startup companies? There's the friends and family rounds, which are people giving you yourself as a founder doing your own personal investing, and Uncle Bob and Aunt Mary might either give you loans or equity-based capital. It can include what's called crowdfunding, platforms like WeFunder, for example, and sometimes very, very early angels. There's also something called a revenue share agreement. Most of the startup companies that we're talking about and the types of companies you'll grow, you won't be doing revenue share agreements. So we won't go into great detail. Some things to keep in mind are ways to continue to bring in capital and also reduce your bottom line. Cash flow tactics, optimizing your use of accounts payable, receivables, and supplier terms to improve accessible cash for your operations. You always want to have as much cash as possible in the bank to operate at any given time. How are other ways that you can bring in revenue? Obviously, non-dilutive money is more ideal, especially the earliest stages that you are, while you're de-risking your innovation. So grants are a great way to do that. And many of you are very accustomed to utilizing grants for your research, given the type of innovations that you have. And there are many ways to find them. Grants.gov is one that you may not have heard of before or paid attention to. And also in the Commonwealth, the Virginia Innovation Partnership Corporation, people call it VIPC oftentimes, and it used to be called CIT. They have a ton of different resources, not only for capital that they can spend into the company through both grants and also equity. They can provide you with training and workshops on how to actually apply for those sources of funding. So VIPC is a great resource. And then also, if you haven't already established connection with your local small business development center, in addition to working with the Tech Transfer and Ventures division of VCU, I would highly encourage you to also get advice and counsel, which is free of charge to small businesses. Early capital sources continuing. Strategic alliances. Oftentimes you can use the assets of other organizations or supply chain partners to leverage. Loans and lines of credit are very useful, building that credit foundation for the business. And then equity investments. And that's where we're going to talk a little bit more about today. Exchanging of an asset, in this case, ownership in the business, shares or promises of shares. And this does include angel funding. So what is equity capital? It is very high risk capital that is put into your put into your startup at a very early stage of your business, usually raising less than $5 million or no more than $5 million is typical for an angel round. Venture capital is what comes after angel capital is raised, right? So the difference, a lot of times equity capital is broken down between angel funding and venture funding. Venture is more serious and has heavier terms, costs more money, and is typically, if you're raising more than $50 million, and sometimes it's up to 50 million or more. So an angel is also known as an accredited investor. And a lot of people ask, well, how do you become an accredited investor? It's not something you do as much as who you are. So these are individuals that are defined by the Securities and Exchange Commission as meeting a certain criteria. This is what makes somebody an accredited investor, according to the SEC, is that they have an annual income of $200,000 or more for the past 2 years, or $300,000 or more for married couples. Also, in addition to that, it can be either or, a personal net worth of at least $1 million, excluding their primary residence. And that's the gist of what makes somebody an accredited investor. There are other ways to qualify, but these are the primary ones that you will typically see. And angels are typically wealthy individuals who invest their own money in high growth startups and people who've made their money in other industries. Oftentimes they're former lawyers or current lawyers even, or bankers or somehow in finance. And what are angel groups? So there are lots of angel groups across the entire United States. And the Charlottesville Angel Network is one we formed in 2015. And since 2015, we've put about $19 million in about 75 startup companies. 50% of them are in the Commonwealth. And many of them are Charlottesville or closer. Actually, 75% of them are in the Commonwealth. And a great many of them are in Charlottesville or surrounding, like Richmond. Angel groups operate differently depending on the theses of the company or those who've come together as the founding members of the group. And it's typically a membership-based organization, so you pay dues to become a member of a particular angel group. They convene most often in person, not always. There are some groups that do it virtually only, like Cav Angels, also based in Charlottesville, and they invest in UVA alumni companies. Some of them create funds or a sidecar fund, and a fund is something that other people manage. They decide what investments they're going to make, which startups are going to get capital. But most of the time, each individual angel member in their respective group decides on a deal by deal basis which startups they want to actually put their own money into. Angels typically, you'll hear this, they're looking for the goose that lays that golden egg or the unicorn. But there are many things that are not a fit, and there will not be a golden egg or a unicorn. They include Main Street businesses. They're typically not scalable businesses. They're common businesses that you see in shopping centers. They're retail businesses of sorts, and they're not ones that have high growth potential. They can also fall into what's called a lifestyle business, which this is a great business. It's employed 20 people, but I have no plan on going anywhere. I, as the founder, am going to be the CEO, and I'm just going to continue to take a salary from this job and employ these 20 people or 15 people or 10 people, whatever it is, but I'm just going to keep it going. I have no exit plan. That's what we call a lifestyle business. There's no exit. So also franchises are never a good fit for angel investments. It could mean that there's one angel that decides that they want to put money into something, but that's not what I would consider an angel investment group, or angel group investment, or a typical angel deal. Food businesses are often excluded. There are some exceptions. There are things that get a lot of traction. It could be, some sort of a beverage, for example, a CPG product that goes wide in its market. So there are some exceptions, and definitely not typical for restaurants to also fall into that space. Nonprofit businesses, they are different from what's called a B Corp business. People ask this question a lot. So a nonprofit, the things that make them distinctly different from what's called a B Corp business or benefit corp is ownership. So in a nonprofit business, you have no owners, right? You have a board of directors, you have officers, and you have staff typically. But in a B Corp business, even though you're not trying to necessarily make a huge profit, or maybe you are, and you can be a benefit corporation and try to make as much money as possible, but you have other metrics that you're measuring your company on, and they could be social, economic impact for the community, and so on. And they do have owners of their business, so they are different. Ideas without any customer traction or technological proof, those, if you have a great idea, but you don't actually have a business to back it, or you're a company without a team that really can't advance it, those aren't angel funding worthy. So these are things that you need to keep in mind as you consider what angel investing may or may not be a fit for your startups. And then also just generally understanding their theses. Angels invest to achieve significant return on investment. That is, by and large, the common denominator. They want to get their money back before they're too old, and they want to put their hard-earned money to use in a way that they enjoy. And the angels that I know that do investing, they're very engaged in learning whatever the startup company's industry or segment is in. So they may not be a biotech investor by nature. They don't have that understanding. They don't really have the experience. They're not subject matter experts in medical devices or drug development, but they may follow the lead on people in the group that they rely on for vetting a deal. So they really enjoy the process of learning, and they are in a group to be around their peers to help them make better decisions around what may be investable in a sector that they don't necessarily understand. Cybersecurity, it could go the other way. They could be a life science expert but not know anything about cybersecurity or technology, as in like a SaaS company, but they may have others in the group that they rely on to help them vet those deals. Angel investors, sorry, we don't need that information. Angel capital fit, your company really needs to be able to achieve significant growth. That's the big one. You have to have a large market, and you need to be willing to sell all or part of your business within a certain amount of time. This says 5 to 7 years of raising seed capital. There are definitely exceptions. Drug development takes much longer, and that would be an outlier from this. And then returns between 5 and 10x are really achievable. And that typically means that your valuation is going to be 50 million or more at the end of the day when you sell your business or get acquired. An angel investment deal is typically either an equity investment or a convertible note. Now, the differences between the two is an equity investment is a simple purchase of shares in your company. So investor X is going to get 3% of your company. right at the start of the deal. The convertible note, on the other hand, is a loan. And these are also quite common, a loan that converts into equity at a later date. So it could be $100,000, it could be $500,000 that gets invested into your company, and it's considered a loan, and there is interest on that loan. And then when a certain milestone hits, and again, it is typically not date oriented, it is typically when you're going to raise capital again, which means that your company has increased in valuation and you're ready then to raise more capital, which is common and expected of startup companies of this nature. Angel investors never expect that they're going to be the first money in and that's it. They're at the very early stages of investing in your startup, and they understand that you're going to have a period of time in which you're going to be raising capital. Sometimes you'll do an additional seed round. Sometimes you'll need what's called a gap fund or a bridge loan to get you from point A to point B before you're ready to raise capital again with new investors. So you might go back to your pool of investors and ask for a little bit more. They always know that you'll be raising again. And we always encourage our angels to keep some powder dry, knowing that they're going to want to invest in you again when you're ready and you hit those milestones that are agreed upon. Stages of growth. Remember, we talked about different capital sources for different stages. The stages where angels really focus are in the pre-seed, the seed, the startup, and the growth phases. And then beyond that, you're really going to be looking at traditional or venture capital. And as you continue to expand, you'll get into IPOs and mergers and acquisitions, anything of 50 million and above. There's also grants and loans and things that also contribute to the success of the capital that is put in by angels, such as the CDFI, which are loans that can be given to a startup that are supposed to advance the community's interests, if you will. Again, what makes an investor want to invest? Why do they invest? Supporting early entrepreneurs is fun? Maybe. It's less risky than stock market? Definitely not. It's trust. Trust in you as the founder, trust in your team, and trust in your innovation. So let's talk about what an investor presentation really looks like. If you're going to go to an angel or an angel group, what are we looking for? There's a certain formula. You can pretty much guarantee that all investor decks are going to have these slides. And there will be more sometimes, and there will be less sometimes, depending on what your goals are. And we'll talk about each of these. First things first, when you are raising capital, the time is right, and you're putting together a slide deck that's going to talk about your startup company. You want to try to keep your deck to 15 slides. On average, 1 minute of presentation is expected per slide. And you want to use an addendum for detailed data, long, complicated, more detail-oriented financials as an example, or it could be clinical trial data or some scientific laboratory-related data, or it could be marketing data. Anything that's really detailed-oriented, you want to maybe put in an addendum or save for the Q&A. It's always great to have it that you can pull it when Q&A time comes and reference it. Know what your audience cares about. Really emphasize those things. Are they really looking for return on investment? Are they driven by their social or some sort of community impact? And then also using color, using language, using images that represent your brand. It's important to have a general understanding of that when you are a startup company. So let's say you have an innovation, you've decided that it's capital worthy and that you want to commercialize it. So you're going through that process. And branding is one thing you always want to keep in mind. What is the name of your startup? What is your color scheme and your marketing? And then use imagery that really aligns with that. And this is at the time when you go from more of an academic looking slide deck to a startup looking slide deck. And there are distinct differences. One of them is also not using jargon. It is very common, especially for academic founders who are talking about their business, to use jargon. We don't all understand, the FDA approval process, for example. We don't necessarily know what the differences are in the different stages, and what pharmacokinetics means. So when you're talking about things, you want to dumb it down a bit in terms of your the meaning of the word and how it will land on an investor who may not really understand that space. Also, this is kind of interesting. Take the oldest person you expect to be in your audience, cut that in half, and that's your font size. It is impossible to get interest from any investors if they can't even read your deck. I have actually seen startup companies completely fail simply because the people in the room had such a small font size that people couldn't read it or see it, and it was very frustrating, so they just tune out. All right, let's talk about some of these important slides that you're going to want to have in your deck. You want to have a very short statement. You hear people talk about it as an elevator pitch oftentimes. What is your vision in 2 sentences? In a nutshell, it really means what's the problem and the solution. Succinctly describe that value proposition to the world that your innovation brings. Why are you commercializing this product or this service or this concept? The greater vision of your business needs to be incorporated into that 2-sentence elevator pitch. One way to do this is write down why you got into the business and ultimately what your vision is. Then take a look at it, evaluate every single word that you've written down, remove extra words, find a way to shorten it, use ChatGPT, throw that in there and say, please turn this into an elevator pitch, and let it spit it out for you and see if you like it. Distill it down to 1 or 2 powerful sentences. Slide 2, what's the problem? What are you trying to solve? We want to understand the pain points that this innovation, that this startup is going to solve. What isn't working, what's missing, and how are you that? How are you going to solve that? Use data to make it clear why it's an important problem that you're trying to solve. Definitely avoid jargon. The solution, you are the solution. Your innovation is the solution. And this particular startup company is bringing that forward. Why is it better or different? What is that value proposition? Again, what value do customers see in your solution? Always talk about it from a customer perspective. The problem that you're solving, the audience that you're serving, which is your target audience, your market, and what they see as the value. What are the customer returns on investment? If I buy this, what am I going to get for it? Is it something social, environmental, health, financial? What is that value? All right, very important. You need to show customer market. You need to show traction and validation. So this is also known as the does anyone care or is this a hobby slide? And oftentimes angels will say it's not a business, it's a hobby. I've also heard it's not a business, it's it's a lab project. So you really want to drill down on the importance of, does the market want your solution? Who is that market? And then prove that to your audience via testimonials or customer quote if you've gotten far enough in your commercialization process that you actually have customers. You can also use successful competition in similar markets. You can compare and contrast yourself to similar types of improvements made that were successful and use that as a comp. Customer pipeline, sorry. Sorry, just one moment. All right, That's Ellie's dog. um, a really great resource for academic researchers to get to the bottom line of customers and is there a market is the iCore program. And I imagine that many of you have already gone through this program, or if not, you can talk to your team there at VCU, TechTransfer and Ventures, to find out how to get into your iCore program. But those are customer discovery courses, and you take them over a short period of time. And it really, really does an amazing job of helping you determine this. Leo, stop. Um, and the difference between iCore and iCap is simply that iCore is for academic research and innovations, and iCap is for non-academic. Market opportunity. Who cares about your solution? We really need to know that there's a big enough market to grow a good business. So your market share is super important. How big is that market locally, regionally, nationally, or further? This really does require market research. And another tip for you is your local SBDC office has tons of market research tools. They have data that they can pull for you that's very specific to your market and get you that for free. That's what I love about the SBDC is that they do work hard for small businesses, and there's certain things that they're really good at. Market research is one of them. Are there multiple market segments for your solution? And we love to hear that. Angel groups, angels, investors, they all love to hear that you have multiple markets you can go after. Super important for you to identify which market you go after first and why. It would not benefit you to say that you're going to go after all the markets all at one time. So it's good to have a strategy and help explain where you want to get traction first. And then once you've proven traction, then you might go into another market segment. Revenue model. How is this business going to make money? It's great to bring inventions to market that save human lives and increase human health or decrease negative environmental impact, but we also need to know that you're going to make money, right? How much will you charge? Will it be more than the costs of running the business? That's super important. Know your cost to produce the product or the service that you're bringing to market. Can you compete on cost, or does your value proposition have a different price point? The volume of sales that you have need to reach profitability. Have you demonstrated that the market is willing to pay? Again, the iCore program is great to help you get through revenue models after you've done customer discovery. Marketing growth strategy. How will you reach customers? What's your market plan? What's your sales strategy? Those are two distinctly different things. And what do you need to increase your sales to grow? It is good to have a growth chart or a timeline here to show where you see your growth scaling over time. You expect to get this many sales, and that's achievable with the plan that you have in place. And then you expect to reach this many once you maybe do another thing like raise more capital, and you can then expand your team and grow your sales. Speaking of team, investors are looking not just at your innovation, because your innovation is your horse. The team is the jockey. So you as a founder, if you're going to be the CEO of the company and run the company, the question is, are you the right person to run this company? And the answer is not always yes. It could be that you bring on team members and that maybe you have that position as CEO initially, but then you move over to maybe chief scientific officer and you bring in somebody who has more business acumen than you and you retain them. And the question is, how will you recruit them? How will you retain them? If it's not going to be you, and that's perfectly acceptable, how are you going to identify them and when can you bring them onto the team? Ask yourself, are you an entrepreneur? Do you even want to be an entrepreneur? Or is it just the thing that you think you have to do to move this innovation to commercialize your product or your innovation? Think about the steps that that's going to take, how long it might take, the skills that you'll need to have. And if you don't feel like you're a fit, talk to other people about that. Maybe there's a co-founder there for you. A question that we often ask is this person going to be willing to pivot if necessary? If your innovation doesn't prove to do exactly what you think it is, but there's a better way to get that to market, are you willing to pivot? So the flexibility of the founder is also really important, and the team. And do you have subject matter experts as advisors and counselors? Are they on your scientific advisory board? Do you have a bevy of people that you can show us that you've got this team behind you with this expertise? People have been there and done that. And what skills and experience do they all have? It is the time to brag. It is the time to highlight strengths, but it is super important to be concise. So we don't want to see pages and pages and pages of your team. We want to see the core team members, who they are and what they've accomplished, who they are and what they've accomplished. Financials. You need to be able to demonstrate you have adequate cash flow for 6, 12, 18 months and beyond. How about your 3 to 5 year plan? Do you have one? Have you considered one? What do you think that's going to be? These are all projections, and we absolutely realize it and recognize this, but investors want to know that you've thought through this process. What would you consider to be success? And do you have a milestone and sales plan in place to get you there? That's what we're looking for with your financials. Competition. I can't tell you how many times we've seen people come and say that there is no competition in their space. And the reality is absolutely every business has a competition, even if it's currently they do nothing. Sometimes competition is really good. In other words, it brings about something called co-opetition. So more than one of a kind, helps the market recognize the value and that there are multiple things that they can do to improve their health or improve the situation. And you guys can be competitively cooperative. Important about competition is to know who your competitors are and how you compare to them. Being really honest about what makes you different is vital for the segment. Oftentimes this will look like a matrix, and it'll have all the benefits that you offer, and then your competitors and little check marks in the boxes. We do all of these things and these competitors only do X and such, or they're limited by various maybe it's a disease indication. How do you compete on intellectual property? Customer experience, price, mechanism of action, standard of care. And does your ideal customer profile vary with your competitors? Sorry. Ellie, can you bring me a cough drop? The ask. Knowing when to ask for seed capital is really important. How much you're seeking to raise is in your ask slide. If you've decided that you're initially going to start raising in your early stage $500,000, you'll want to indicate that. Thank you very much. And what are the terms of the offering? Sorry, I forgot to finish this slide. Terms of the offering can be whether it's an equity raise, or if you're going to do a convertible note as an example. Sorry, the spring weather has brought on this cough. Thanks for bearing with me. The ask is going to depend on your audience. Are you raising from angels? Your ask slide is really going to be drill down on the terms of the offering, the key milestones and timeline, and how you're going to use those funds. Other times you're going to be looking to win a competition of sorts, and those have different criteria. How do you meet the criteria for the competition? How are you going to spend that capital? that you win as a prize. How are you going to use the funds to advance your innovation in your startup? There are lots of different tools. Here are just a few that can help you as you're going through this story and as you're trying to build a pitch deck for your company and your startup at any point. I always advise that you have given thought to your deck. If you give thought to a startup deck, it means that you understand the various components to raising capital and that you're thinking through those questions. Ready to start meeting angels? Virginia is an active investor state. Start connecting. Meet them at networking events. I know that Evelina and her team do a really great job putting together networking events and educational events. Be at those meetings. Come out and network as much as you possibly can. Prepare with advisors and mentors. Meet with the fellows at the SBDC office. Meet with the folks there at the TechTransfer and Venture Group. Talk to your tech council. Apply for what's called Pitch Preview for early investor feedback. Pitch Preview is actually a part of the Central Virginia Small Business Development Center and the Virginia SBDC and the Charlottesville Angel Network, where we have about once a quarter an opportunity with a window, a deadline to apply for a particular date. And we bring on a team of actual angel investors who will take a look at your deck and give you really honest feedback, not just about your deck, but about your business and things, and have you thought through this aspect of your business? And what happens if this happens within your market segment and so on? That investor feedback is really vital. And a lot of people don't get the opportunity to speak to angels and get that level of feedback before they go before a group for actual fundraising. Pick the angel groups that you want to go see. There is a platform called gust.com, like a gust of wind. And on that platform, startup companies create a profile for themselves, and then they create a financing round specific with the terms and how much you're trying to raise. And and then you go to a section that lets you choose the different resources, the different angel groups that you want to apply for funding to. And a lot of them may be in your area or out of your area. It's interesting to find the ones that know your sweet spot, understand your market segment, or are geographically invest in the region, like the Charlottesville Angel Network. We always take a good look at deals that are in the Commonwealth of Virginia. There are other tools to look for sources of capital, Crunchbase, PitchBook, and industry connections. So look, expand your market and expand your mind, expand your network. Look at these different sources and determine the sources that seem to be the best fit for what you are offering. We also recommend this particular book by David Rose called Angel Investing. Sorry for the coughing. That is all I have. Ellie?
Great. Thank you so much, Tracey. If you keep your presentation up, just in case you need to access it during the Q&A session, we'll get started. Again, if you do have any questions for Tracey or Evelina, put it in the chat and we can go one by one. Somebody said, will the recording be shared after the meeting? Our communications team is going to work with Tracey to get her presentation, this video up, and we'll get it somewhere on our website and send the link out, probably in our newsletter as well. Are there any other questions? Comments, concerns? Is there anything that anybody would like to see in the future, a future entrepreneurship and action learning series presentation?
I will also ask the question, is there anything specific that you learned today that your aha moment or your takeaway? What was that, and what might you want to see more of in this particular presentation?
Doesn't seem like
Well,
anything's coming through the chat.
Sure.
Oh,
So I had a question on your convertible notes, and perhaps a little bit more detail on that, because it sounds like it's a loan that gets potentially converted into equity, or the alternative of that is that the founders sort of repay it on some schedule.
Mhm.
Exactly, a couple more details on convertible notes would be helpful.
Okay, just a few things quickly I can say about that, and there are a lot of things that can be said about all the mechanisms for making investments and negotiations, and val cap and a whole bunch of lingo that goes into it. And I will offer another session specifically on that. um, when you have a convertible note, it is expected that you'll have an agreed upon interest rate. What would that interest rate be? And um, there's also what's called a valuation cap. So you and the investors will determine, what you think the company is valued at, and when you're raising capital the next time, what that valuation cap will be, because the lower the val cap, the better for the investors, the valuation itself. So they want to know what that is. And there could be other terms. Now, it's more common that convertible notes will actually convert to interest than not. So the milestone could be that it's the next time you raise capital. So let's say it's 18 months from now, and you would determine at that point that's the triggering event for the convertible note to then just completely convert to equity. And you would include the interest amount that's been calculated,
Accrued.
accrued, towards your equity. Make sense?
Thank you.
Yeah, you're welcome.
our question came in. Are there any resources or templates for financials, operating costs to generate your 3 to 5 year plan?
This is where I would highly recommend that you talk with the fellows, the folks over at the Small Business Development Center. They are extremely good at helping you with your financials, and finding those templates. I personally don't have any other resources other than using companies like Sandbox. Sandbox is a vendor. It's in Richmond, female founded, and incredible team of people that can sit down with you and help you prepare for raising capital. And they do so at a fair rate. It does cost money. That's not a free resource, but almost, I can't tell you, the majority of companies that come through to us from the Richmond market have all gone through Sandbox as a vendor to help get their financials ginned up. So just another resource, although again, it's not a free one, but a very good one.
Awesome. I don't think I see any other questions. I did get your note about I-Corps programs. We'll take that into consideration for future presentations. Evelina, any last words? Anything you'd like to say before?
Well, thank you all for participating. I guess everything is clear from Tracy's presentation. Thank you, Tracy, for being the first presenter.
You're
Kick off
welcome.
the series. Looking forward to the next one. Please, in the meanwhile, email us with any questions, any suggestions for speakers, for topics to cover. And I'm looking forward to a great pitch day on May 13th.
Thanks, everybody.
Thank
Bye.
you. Bye.
Bye-bye.